Let me guess, you own or want to own a rental property. You make good money, but the bank says, sorry, you don't qualify. That's exactly why DSCR mortgages exist. If you're a real estate investor who's tired of handing over tax returns, W-2s, and explanations for every single write-off, this video is for you. Today I'm going to explain the basics of a DSCR mortgage, what it is, how it works, who it's for, and would it actually make sense to use one. No hype, no jargon, just plain English. Hey, do me a favor and please hit the like and subscribe button below. It'll really help me out. Thank you. What is a DSCR mortgage? DSCR stands for Debt Service Coverage Ratio, but here's the simplest way to understand it. A DSCR loan qualifies the property, not the borrower. Instead of asking how much you make, the lender asks one question. Does this property make enough rent to cover the mortgage payment? If the answer is yes, then you're probably going to qualify. That means no tax returns, no W-2s, no debt-to-income ratio. That's why DSCR loans are so popular with real estate investors. How the ratio is calculated. This part is actually very simple. The ratio equals the monthly rental income divided by the total monthly housing payment. The housing payment includes principal and interest, property taxes, insurance, and HOA if applicable. Here's an example. If a property rents for $2,000 per month and the total mortgage payment is $1,600 per month, 2,000 divided by 1,600 equals 1.25 ratio. That means the property produces 25% more income than the payment. Most DSCR lenders want to see a ratio of 1.0 or better, which means the rent and mortgage payment are about equal. Some lenders will allow for a lower ratio with higher down payment or reserves. Who DSCR loans are for? DSCR loans are designed specifically for real estate investors. They work well if you're self-employed, you invest inside an LLC, you write off a lot of income, and you want to scale a rental portfolio. They're not designed for primary residences, buyers chasing the lowest possible rate, or owner-occupied house hackers. Think of a DSCR loan as a business loan property. Here's what lenders actually care about on a DSCR loan. First and foremost, your credit score. Most programs require a minimum score of 620. The better the credit score will usually get you better terms. Second is down payment, typically 20 to 25% down for purchases and similar equity requirements for refinances. Third is the property itself. These loans are good for single-family homes, 2 to 4 unit homes, and some condos. Fourth, cash reserves. Most lenders want 3 to 12 months of payments in reserves. And notice what's missing? No income verification, no employment history, no debt-to-income ratio. Here are some common myths about these loans. Let's clear them up. Myth number 1, DSCR loans are only for big investors. That's false. First-time investors use DSCR loans every single day. Myth number 2, DSCR rates are always terrible. That's also false. They're usually a little higher than primary home loans, but competitive with other investor financing. Myth number 3, credit doesn't matter. Credit still matters. It matters a lot. You just don't have to document your income. Here are some pros and cons. Let's talk about the pros first. DSCR loans offer no income documentation, easier scalability, investor-friendly underwriting, and LLC compatibility. Now the cons. The rates will be a little bit higher, you require a larger down payment, and you're going to have fewer lender options than conventional loans. The bottom line is DSCR loans trade at slightly higher cost for flexibility and speed. For many investors, that trade-off makes sense. Here's a real-world example I see all the time. An investor owns multiple rental properties. The cash flow is strong, but tax returns show very little income due to depreciation and write-offs. A conventional lender says no. A DSCR lender says, does each property cash flow? That investor refinances using the DSCR loan, pulls equity, and buys the next property without touching tax returns. The DSCR lender says, Does each property cash flow? That investor refinances using a DSCR loan, pulls equity, and buys the next property without touching tax returns. That's how investors scale using DSCR financing. If traditional financing is slowing you down, then this can be a powerful tool. If you want to know whether a property qualifies, or what the ratio looks like on a deal you're working on, or how DSCR compares to a conventional mortgage, reach out. I'll walk you through the numbers and help you choose the right tool for the strategy. Thanks for watching.